Bismillahirrahmanirrahim. Dear students, Assalamu alaikum and welcome back in lecture number 14. We are discussing Islamic modes of financing, and we have discussed Murabha mode of financing, Salam and Istisna mode of financing, and in our previous lecture we discussed Musharakah mode of financing. And before we go into details of this lecture, that is Mudarba mode of financing, before we go into details of today's lecture, that is Mudarba mode of financing, let's have a look about the previous lecture. We covered the following topics in the previous lecture, that is the concept of Musharakah contract, the definition of Musharakah, that is it is a partnership agreement between the two or more partners, and they agree to share the profits on an agreed ratio, and the loss sharing mechanism is clear, that is it should be according to the proportion of investment. And we discussed the features of Musharakah contract, that is the capital contribution, the nature of the capital contribution, the terms of capital contribution, and the management of Musharakah venture, that what will be the operations, who is going to be responsible of the business operations, so whether there will be some working partners and the sleeping partners, and whether all the partners, they are sleeping partners and they hire some managers for the sake of that venture. And the profit sharing mechanism, that is they share the profits as the agreed ratio. It may be different from the capital contribution ratio, and there can be some salary or remuneration for the working partner, or there can be an increase in the profit share of the working partner. And also the loss sharing mechanism, that is the losses should be according to the proportion of investment, and accordingly capital loss will also be according to the proportionate capital contribution. And the partnership venture, the ventures that can be financed or undertaken with the Musharakah contract should also be Sharia compliant. No haram activity which is non-Sharia compliant, it is not allowed in the Islamic financial system. And the learning outcomes of this lecture would be that you will be able to understand one of the most important features of Islamic financial system, that is Mudarba mode of financing, and the principles of Mudarba and the uses of Mudarba. So these things you will be able to learn after this lecture. First of all, the definition. This is a kind of partnership between the partners where one of the partner is the working partner or the manager, and the other partner or partners, they will be the capital provider. So normally the capital provider is known as Rabbul Mal in Arabic, and the entrepreneur and the capital provider, they join together and they enter into an agreement which is known as Mudarba contract. So Mudarib, or the manager or the entrepreneur, and the capital provider, they agree on a profit sharing ratio. So the profit sharing ratio will be agreed upon based upon the activities of the manager and the nature of the capital. So for example, if the capital contribution is 100% of course from the capital provider and 0% is from the manager, but the manager puts his efforts into the business, so the profit sharing ratio can be 50% each, or it can vary depending upon the nature of the business. And the investment comes 100% from the Rabbul Mal, while the management and work is an exclusive responsibility of the working partner, who is called Mudarib. Now the features of Mudarba, there are certain features. First of all, the nature of the contract, and then the capital, which is again one of the important features of the Mudarba contract, and the management of the Mudarba, and profit and loss sharing mechanism. First of all, we will be discussing the nature of the contract. So generally, Mudarba contract allows any one of the contracting parties to terminate the contract unilaterally. So because partners in their capacities, they have the right to terminate the partnership at any time. So just like that, in a Mudarba contract, both of the partners, they have the right to unilaterally quit from partnership, and they can notify the other parties and they can quit from the partnership. But there can be certain restrictions. For example, if the Mudarba is for a particular time period, then the partnership will terminate automatically at the end of that time period. And if the partnership is for a specific project, then before the completion of the project, parties cannot quit unilaterally. So these exceptions are there. Then the important feature of a Mudarba contract is the capital. Just like Musharakah contract, we have many features for the capital in case of Mudarba, and they are somewhat similar to each other. The capital shall be contributed by the capital provider and shall be managed by the manager to generate income. So the objective is to generate income for both the parties, that is the capital provider and the manager. The capital of Mudarba may be in the form of monetary or non-monetary assets. So just like in case of Musharakah we discussed, the capital can be in monetary terms or it can be non-monetary assets, like the contribution in the form of buildings, land, machinery, or anything. And the monetary assets of different currencies shall be valued according to an agreed currency at the time of signing the Mudarba contract. So its example would be that an Islamic financial institution has launched a global Mudarba fund. So if a financial institution launches a global Mudarba fund, the fund accepts investment in various currencies such as US dollar, euro, ringgit Malaysia, Saudi Riyal. So it attracts investment from different parts of the world. So those investments will be in different currencies. However, the prospectus of that fund has stated that the Mudarba fund is determined in US dollar. So if the standard currency is determined in US dollar, then all contributions of investors in non-US dollars will be converted into US dollars equivalent amount based on the exchange rate on the day of subscription to the Mudarba fund. And the day when the capital contribution takes place, at that time, according to the exchange rate, the worth of that currency will be determined into the currency mentioned in the prospectus of that fund. That was, in this example, it will be converted into US dollar. The mutually agreed currency shall be applicable throughout the Mudarba business venture. For example, during the course of that business venture, if any new partner enters into the business, any new capital provider provides some capital into that business or contributes a capital, so that capital shall also be converted into the US dollar. So until the end of this Mudarba contract or that particular venture, the standard currency which has been mentioned in the prospectus shall remain the same. So as was mentioned, that capital contribution can take place in the form of monetary assets or in the form of non-monetary assets. So in case of non-monetary assets, the worth or the value of the capital will be determined by any independent party or third party evaluation. The experts or other third parties, as agreed, they will evaluate the worth of this asset, and that will be the contribution of the partner. So the non-monetary Mudarba capital contributed may be redeemed at its original value invested, should it be possible, or otherwise as its residual market value upon termination of the expiry of the contract. So when the contract of Mudarba finishes, so for example, if it was for a particular project, so when that project has been completed, so in that case, the non-monetary assets which were contributed into that Mudarba contract, there are two possibilities for that. One is that it will be returned back to the contributor and it will not be judged on the market value at the time of contribution. Suppose a machinery which had a worth of 1 million rupees at the time of contribution, and at the end of the Mudarba contract, its worth might be 0.8 million. So in that case, this will be the loss of the capital provider, but that will be compensated in the profit sharing ratio. The share of profit will be higher in such case, and then it might be based upon the market value. So then at that case, when the Mudarba contract finishes or the project completes, so at that time the worth of that asset will be determined in the market, and accordingly the asset will be compensated for any capital losses, and the capital gains will be distributed according to the agreement. And its illustration would be like that: if a public transportation company, suppose XYZ company, applies for Mudarba based financing from an Islamic bank, the bank approves the application and agrees to provide 5 buses to the company as a Mudarba capital valued at 10 million rupees based on the prevailing market value. So the market value of 5 buses at the time of capital contribution in non-monetary assets, it was worth 10 million rupees, and the company should manage the operations of these buses. Upon the termination of the contract, Mudarba capital may be valued at its original value or the residual market value as agreed in the contract. So as per the agreement, if it was agreed that the assets will be valued at the time of contribution, suppose it was 10 million rupees, so at the completion of the project, their worth would be 10 million rupees. And if it was agreed that the worth of these assets will be determined at the time of completion of the project, then the market value will be determined at the time of completion of that project. And the debts or the receivables to any of the capital provider cannot make part of the capital contribution. So they don't qualify as a capital of Mudarba. Just like in the case of Musharakah, the capital cannot be in the form of promissory notes or accounts receivable. Rather, it should be in some monetary terms or in some assets, or tangible or non-tangible assets. The agreed capital shall be made available to the manager to commence the business activities. The agreed capital, which was agreed in the Mudarba contract, will be made available to the other party, that is the manager, at the time specified in the contract, and the capital may be fully or partially disbursed or made available to the manager at the time of the contract or based on the terms of the contract. So it is mentioned in the contract that capital will be provided fully or partially. Partially would mean that some percentage of the capital would be provided in the beginning, and then after a particular time period, and then after a particular time period, depending upon the nature of the contract. It may be 10% at the end of every month, or it may be provided 100% at the time of the contract. And both the partners in the Mudarba contract, they can agree upon the condition that the capital provider will withdraw his or her capital gradually from the Mudarba agreement, from that Mudarba business. For example, if the contribution was 100% from the capital provider, and then according to the agreement, the capital provider withdraws 20% every year, then those 20% can be purchased from the Mudarib or the entrepreneur, or it can take place in the form of elimination of that business gradually. It means after 5 years the business will finish. Or if the share of the capital of the capital provider is purchased by the Mudarib gradually, then at the first step, when manager purchases the first lot of the share of the capital provider, then at that time they both become partners. Now the contract takes place a kind of Musharakah. From Mudarba, now it has been converted to Musharakah. And the other arrangement is that the share of the capital provider can be purchased by any third party. So in that case, the nature of the contract would remain as Mudarba between the capital provider and the Mudarib, whereas the capital providers among themselves, they will be partners, and the contract between them would be a Musharakah contract. And if the capital provider fails to provide the capital as agreed in the terms and conditions of the Mudarba contract, so in that case, the Mudarba contract will be terminated. And this is also possible that partial payment has been made in the form of capital contribution. Suppose 50% of capital has been provided to the Mudarib, and remaining 50% the capital provider doesn't supply. So in that case, there is an option for the Mudarib to terminate that contract, and both the parties, if they agree, they can agree on that provided capital, and they can enter into another contract based upon the actual capital contribution. So this condition is same as that of Musharakah contract. And when the Mudarba agreement is terminated, the capital which was provided by the capital provider to the Mudarib, then this is the liability of the manager to return back that capital to the capital provider. And if some assets have been purchased during the course of this Mudarba contract, so those assets will be liquidated and it will be returned back to the capital provider. And there will be some liabilities of the Mudarba business. For example, if the amount of capital that was provided for that Mudarba business was 10,000 rupees and the business was engaged and some business activities took place, assets were purchased, and there were certain liabilities created against those business activities. So those liabilities will not exceed the 10,000 rupees of capital contribution by the capital provider. So the liability of the capital provider will be up to the limit of the capital provided into that business. The liabilities will not exceed more than that. And all the liabilities will be compensated first, and then the liquidated assets will be used to pay back the capital to the capital provider. And in case of liquidation, that is when the Mudarba contract terminates or finishes, and then the liquidation takes place, at that time the outstanding capital which was contributed by the capital provider shall be returned back to the capital provider. And if there was some profits, and the share of the profit of the capital provider will also be outstanding, so in that case the capital contribution plus the amount of profit which was outstanding, both of these amounts, they will be liability of the business or the manager, and it will be returned to the capital provider. And then the manager shall not guarantee the Mudarba capital. So during the course of business, it is possible that capital is lost. So in that case, if it is not a willful or based upon any negligence or misconduct or breach of contract, so in that case, manager is not liable to compensate that capital loss. The capital provider may require the manager to arrange for an independent third-party performance guarantee. This is also possible in this contract, that the capital provider or the Islamic financial institution will ask for a third-party guarantee for the activities of the Mudarba, because the Mudarib is independent in their activities. So in all the business activities, Mudarib is independent. So in that case, there might be some reservations or doubts of the capital provider, and this can be eliminated by appointing a third-party evaluation to guarantee the performance of the Mudarib or the manager. The guarantee shall be executed as a separate contract and be utilized to cover for any loss or depletion of capital in the event of misconduct, negligence, dishonesty, fraud, or breach of the terms of the contract by the manager. So just to make sure that manager performs his full in his capacity, full in his or her capacity, and there is no breach of contract, there is no negligence, and there is no intentions of fraud. So to make sure these kind of things, a third-party guarantee can be asked from the manager. And the third-party guarantee in this Mudarba contract can be in the form of guarantee for the Mudarba transactions or for Mudarba capital. So it should monitor that the activities or the business activities of the Mudarba contract are up to the mark. There are no hidden intentions of fraud or some concealment of any facts, and the Mudarba capital is used in the proper way for proper business activities to earn income on these activities. For example, capital employed to sell assets or render services may be accompanied by a third-party guarantee on payment for such sales and services. And Mudarba capital will be used only for the Sharia compliant activities. So this is the basic feature or main feature of any Islamic mode of financing, that all the activities financed with any mode of financing should be Sharia compliant, and any business activity which can lead ultimately towards some haram business activities or the products or services which are not allowed under the Islamic financial system, so the activities, they are not allowed. The next point is that manager or the Mudarib has the exclusive right to manage the contract. The manager is the working partner here. The manager is an entrepreneur here. The capital provider will not put any restrictions on the activities of the Mudarib or the entrepreneur. However, the capital provider has the right to information regarding the conduct of the business and the manager. Because the capital provider has provided the capital, so he or she is concerned about the activities of the business. So the capital provider has the right to look into the business activities and to look into different informations of the business to make sure the conduct of the business is fair. And the manager shall not be liable for any loss of capital unless it is due to any negligence, misconduct, dishonesty, or any breach of contract. So just like in case of Musharakah, where the agent or the working partner is responsible for the misconduct or breach of contract or negligence, same way in case of Mudarba, any negligence, misconduct, or breach of contract would mean that the manager has to compensate the losses. Now, what is negligence, misconduct, or a breach of contract? So negligence is among the typical conditions specified in the Mudaraba contract that managing partner is to exercise due care and diligence. For example, the assets purchased for sales was kept in the store without takaful coverage. Takaful means the insurance. If the assets were not insured while they purchased against fire and theft, as a result of fire, some of the assets perished. So if fire takes place and there was no fire insurance, then the manager is liable for the loss due to his negligence of not obtaining necessary protection. So in that case, this is the mistake or negligence of the partner, that is the manager, not to take care in this case. So not to cover the losses with some takaful or insurance arrangement, this is a negligence on the part of the manager. And misconduct would mean the scope of the Mudaraba agreement is specified in the agreement that Mudaraba fund should be invested in securities with investable grades, and the securities should be from the list agreed by the capital provider. So if the Mudaraba fund was created just to invest into certain securities and they were mentioned in the contract, so at that time when the manager or the Mudarib, he or she thinks that to invest into other securities which are not mentioned in the contract, they might bring some more profits, and this activity leads to some losses. So this loss is due to the misconduct of the business activities against the contract, against the terms and conditions of the contract, and this is the misconduct. So in that case also, manager has to face all the losses. In breach of terms, according to the terms of Mudaraba venture, the manager should disclose all relevant information that is significant for the capital provider to take a decision to participate in the venture. For example, if the business idea that was surfaced by the entrepreneur or the Mudarib, and with some lucrative offers into it, with some higher incentives that this business can earn such and such amount of profits, but the negative side or the darker sides of that business activities, they were concealed and it was hidden intentionally, such that if that information comes into the knowledge of the capital provider would not provide the capital. So with this intention, if something is hidden or concealed, that is the breach of the terms. So in this case, if loss takes place, so that loss will again be compensated from the manager or the Mudarib. Then there are two natures of Mudaraba, that is restricted Mudaraba and unrestricted Mudaraba. So in case of restricted Mudaraba, the powers of the Mudarib, they are restricted. For example, the powers of the manager shall be provided under the terms and conditions of the contract. The contract may restrict the manager's role or functions, such as determination of the location. So where the business will take place, the geographical location. The capital provider may make bound to the manager that business will not be conducted in Karachi, but it will be conducted in Lahore. The geographical restriction. And then the period of investment. It can also be restricted that the investment of this Mudaraba fund will be only for 6 months. So after 6 months, the capital will be withdrawn. And then the type of project. The capital provider can also restrict the type of project. It can be for a particular project, for example, to construct a particular bridge, or to invest into some particular securities, or to take any kind of business activity which is particularly mentioned and specified. And commingling of funds. So the funds which are provided by the capital provider, then the capital provider can restrict the Mudarib that no other funds will be joined or will be mixed into this Mudaraba business. So these are restrictions, and there can be other restrictions, and it will be mentioned in the Mudaraba contract. All these restrictions, they are possible provided that they don't kill the very objective of that business. For example, the objective of the business is to earn profits, but if the restrictions are such that profits are not possible, so in that case, these restrictions are not possible. So the restrictions should be based on some logic, otherwise it will kill the objective of the Mudaraba contract. And in case of unrestricted Mudaraba, Rabbul Mal or the capital provider gives full freedom to the Mudarib to undertake whatever business he or she deems fit. The manager would think that such and such businesses are good, then the manager has the right to engage into those business activities. This is called unrestricted Mudaraba. There are no restrictions or limits and conditions specified, and the manager has the discretion to use the capital in the best interest of the Mudaraba. The condition is that the manager should use the capital in the best interest of the Mudaraba. However, manager or the Mudarib is not authorized to keep another Mudarib as a partner and mix his own investment into that particular business. And this is also not allowed to the Mudarib that he or she can mix his or her own capital into that Mudaraba fund. But this is only possible if the Rabbul Mal or the capital provider is agreed, and then according to the agreement, the Mudarib can also mix his or her own capital into that Mudaraba contract. But in that case, the nature of the contract will change from Mudaraba to Musharakah, because this is the main feature of Musharakah contract, that all the partners, they bring capital into that business, whereas in Mudaraba, the manager doesn't contribute any of the capital into that Mudaraba business venture. So then, if the Mudarib invests his or her own capital and mix it with the capital of the capital provider, then the nature of the contract would change from Mudariba to Musharakah. Then there is further classification of Mudaraba contract, that is single-tier Mudaraba and multi-tiered Mudaraba. In a single-tier Mudaraba, the idea is that the Rabbul Mal provides capital to the Mudarib, and Mudarib will utilize that capital and engage into some business activity. And this is the relationship between the Rabbul Mal and the Mudarib. This is known as the single-tier Mudaraba. Whereas in case of multi-tiered Mudaraba, the Rabbul Mal provides capital to the Mudarib, and then Mudarib may provide the same capital to the next Mudarib. So there will be different tiers of Mudaraba. So this is allowed, and this should be with the consent of the Rabbul Mal. If the Rabbul Mal doesn't allow such type of transaction, then this is not possible. And we have multi-tiered Mudaraba in different forms in the Islamic financial system. Suppose in case of bank, we see the bank is in the center, and in this capacity, bank is Mudarib. And you see, all the depositors, they deposit their funds in the bank, and they are the Rabbul Mal. And bank is the Mudarib. Bank is working as an agent, as a manager, and here the relationship between the depositors and the bank is the first tier or the single tier Mudariba. And these Rabbul Mal, they can deposit their capital in different forms, like in different types of accounts, or maybe for a particular fund. And these capital providers, they are known as Rabbul Mal, and then the bank works as Mudarib. But on the other hand, bank enters into different contracts with different parties, and you can see bank becomes the Rabbul Mal, and these parties, they are the Mudarib. So bank will make investment maybe on the Musharakah basis, maybe on the Mudaraba basis, but if it is on Mudaraba base, then all these investments may be entered with different partners A, B, C and D. So the bank will enter into independent contracts with all these different Mudaribs, and the returns of this business according to the share of the bank will be deposited or will be given back to the bank. Now the bank has provided capital and earning profit or losses against these investments. And out of these profits which the bank receives, so according to the first contract, the bank may deduct the managerial, the fee, maybe the managerial fee, or we may call it a wakala fee, and bank may charge a Mudaraba partnership, the bank may deduct a percentage of profit which is received from the second tiered Mudaraba, and out of this profit, bank would keep certain amount for his or her own its own administrative expenses, and the remaining will be distributed among the depositors. So this phenomena is known as the two-tier Mudaraba. And In Islamic financial system, this arrangement is not only in case of banks, the depositors into the banks and then the clients of the bank for different modes of financing. It can be in the form of different funds as well. For example, when we talk of Mudarba fund, the banks or the financial institutions, they announce different types of fund, as we have discussed them in the Islamic investment funds. And in that case, the investment is invited from all over the world, and the depositors, they deposit their funds into that particular fund, and there is a relationship of Rabbul Mal and Mudarib. The fund manager, which is normally a financial institution or a bank, works in the capacity of a Mudarib. Now the suppliers of that fund, they are the Rabbul Mal, and in their capacity they are partners into that fund. There is a Musharakah contract, maybe we can call it, and the profits will be shared according to the capital contribution by all the capital providers. And then the next relationship with the fund manager is Mudarba based. The profits will be shared between the Rabbul Mal and the financial institution, and then that financial institution will use those funds for different activities. If it is a Mudarba fund, then the bank will supply those funds to different entrepreneurs, to different managers on Mudarba contract, on Mudarba based contract. And again, the shape will be the same as we discussed in this case of bank. So for different types of funds, the fund managers, they will take the central stage, and there will be the first tier Mudarba from all these fund suppliers with the fund manager, and the fund manager will have the second tier Mudarba with all these managers where the investments are made by the funds. So this is the multi-tiered Mudarba concept. Then there are different capacities of Mudarib. The Mudarib has different roles. For example, Amin, because the capital is provided to the Mudarib or the entrepreneur or the manager, then the manager is trusted for that activity, so the manager has a role of Amin or trustee in this case. And Wakil or agent, because the capital provider has provided the full authority to the manager, to the Mudarib, so there is an agency contract also. The Mudarba contract is kind of agency contract between the Mudarib and the capital provider. So the Mudarib or the manager acts as an agent or Wakil on behalf of the capital provider. And the Sharik or partner, so this is, the Mudarba is kind of partnership, so the manager is also a partner to the capital provider, and they share their profits in agreed ratios. And Zamin, that is, the manager is liable for any misconduct or negligence or any breach of contract. So in that case, Mudarib is liable for any damage or loss. And Mudarib is also an employee of the capital provider. For example, if the Mudarba becomes void due to any reason, the Mudarib is entitled to get a fee for his services. For example, because of any reason, if the Mudarba contract could not be followed and there was no business activities taken place to generate profits, and the Mudarib could not earn any profit as his or her own share, so in that case, because of that nature of that activity, the Mudarib can ask for some compensation of his or her efforts that were taken place into that business activity, because against those activities Mudarib could not earn any profits because of the Mudarba contract was void. Now another important feature, that is distribution of profit and loss. Again, this is the same mechanism as in the case of Musharakah, that profits will be distributed as per agreement. It will be different from their capital contribution. It can be different from the capital contribution. Like in this case of Mudarba, capital comes 100% from one capital and the efforts from the other capital. So this is a mixing of the two types of resources, that is monetary resources and human resources. So both of these resources, they will have their share in the profits. So it is necessary for the validity of Mudarba that the parties agree right at the beginning on a definite proportion of the actual profit to which each of them is entitled. So the exact proportion of profits shall be mentioned at the time of the contract. and they can share the profit at any ratio they agree upon. However, in case the parties have entered into mudarba without mentioning the exact proportion of the profit, it will be presumed that the share of profit is in equal ratio. For example, if the mudarba or musharakah contract doesn't specify exactly what is the exact proportion of the profit, so in that case it will be assumed that all the partners, they share profit in equal. For example, if there were 4 partners, A, B, C and D, and all contributed 25% each, and in the mudarba or musharakah contract it was not mentioned that what will be their profit sharing ratio, so then this sharing ratio will be their profit sharing ratio. And if there were 2 partners, for example A and B, and then if it is not mentioned in the contract, then they will share their profits 50% each. And then some incentives may be given to the mudarib. And this is possible, as we discussed in our previous lecture as well, that just to motivate the mudarib or the manager, this can be mentioned in the contract. If the profits go beyond a certain benchmark, then from the extra profits earned, a share can be given more than the profit sharing ratio between the partners. For example, in our previous lecture, we discussed the example that if the profits exceed beyond 500,000 rupees, so then 200,000 rupees of this benchmark will be given to one of the partners or the working partner, and the remaining will be distributed among the partners as per agreed ratio. So this is possible, and the incentives can be given. Apart from the agreed proportion of the profit, the mudarib cannot claim any periodical salary or a fee or remuneration for the work done by him for the mudarba. The mudarib cannot claim any separate fee other than the profits which were agreed in the mudarba contract. The mudarib and Rabbul Mal cannot allocate a lump sum amount of profit for any party, nor can they determine the share of any party at a specific rate tied up with the capital. And this is also not possible that out of the profit, such and such amount will be given to one of the partners. For example, it is not possible that if this is the amount of profits, so out of this profit, first one of the partner, maybe the capital provider, will be given 10,000 rupees, and then the remaining profit will be shared according to the agreed ratio. This is not possible. And also this is not possible that if the capital contribution, suppose, is 1 million, and then at the regular intervals or at the time of distribution of profits, a certain share, a fixed percentage, for example, in this case, a 10% will be given to the capital provider before the profits are distributed. This is again not possible. So these are the conditions for a valid mudarba, that fixation of a certain amount out of profits may be a lump sum amount, or it may be related to the capital contribution. This is not allowed under the Islamic financial system. Now let's see the example here. If the capital is 100,000 rupees and the partners in the mudarba agreement cannot agree on a condition that 10,000 rupees out of this profit shall be the share of mudarib, nor they can say that 20% of the capital shall be given to Rabbul Mal, nor they can say that 20% of the capital shall be given to the Rabbul Mal out of the profit, and however they can agree that 40% of the actual profit go to mudarib and 60% of the profit goes to the Rabbul Mal, or vice versa. So the profit sharing ratio can be any ratio, but the fixation of amounts out of the profit is not allowed under the mudarba. Otherwise it will not be a mudarba contract. This is not allowed under the Islamic economic system. And if the business has incurred loss in some transactions and has gained profits in some other transactions, so then the net profit will be determined. So if the mudarba business has engaged into different business activities, suppose there has been different business activities, and at one place business suffers losses, and at another place business has some profits, and then again the other business generates some profits, so their total will be determined, and net profit will be determined before it is distributed among the partners as per agreed ratio. And what are the effects that will lead towards the termination of the mudarba? So mudaraba can be terminated any time by either of the two parties by giving notice. So this is the conventional partnership agreement, that at any time any of the partner can quit from the partnership by giving notice to the others. And if mudaraba was for a particular term, it will terminate at the end of that term. So if mudaraba was to purchase, suppose for example, if the mudaraba contract took place to purchase wheat and then to sell it in the market, then at the time of that contract, at the time of that trade, when the wheat entered into the market, it was purchased from the farmers and then it was sold in the market, then the objective is achieved. So that is for a particular time period. And then termination of mudaraba means that the mudarib cannot purchase new goods for the mudaraba. So when the contract has been terminated, at that time the mudarib cannot engage into or cannot continue the business activities of the mudaraba. So at that time, the things which can be taken place is the sale of the assets, not engaging into some other business activities or committing funds in some other business activities. And the distribution at the time of termination, if all assets of the mudaraba are in cash form at the time of termination, and some profit has been earned on the principal amount, it shall be distributed between the parties according to the agreed ratio. And then if the assets of mudaraba are not in cash, they will be sold and liquidated so that the actual profit may be determined. So if the contribution of the capital was in the cash form, then out of cash the capital will be delivered back or paid back to the outstanding capital will be given back to the Rabbul Mal, and the profits shall be shared in the agreed proportion. But if after payment of the outstanding capital, if nothing is left, then nobody will be having anything. But if at that time there was some loss, for example, the outstanding capital was 1 million, and what cash was realized after liquidation, it was 0.9 million. So in that case, there is no profit left and all the loss goes to the Rabbul Mal. So instead of getting 1 million, the Rabbul Mal will be getting 0.9 million. So that loss will be the loss of capital provider. So if there is a profit, it will be distributed between the parties according to the agreed ratio, and if no profit is left, mudarib will not get anything. It means in case of loss, mudarib will not be having anything, or mudarib will not be facing any losses. There are different types of mudaraba, that is collective mudaraba. Collective mudaraba would mean that when many of the partners, they join together, they pool their investments, they pool their contributions, and then with that pool of fund, they appoint a manager, or an entrepreneur approaches them and they hand over that capital to that entrepreneur. So that is a collective mudaraba. And the relationship between the investors themselves, which is a shirka or a partnership, and the relationship of all the investors with mudarib, which is a mudaraba. So in this case, suppose there are different parties, different people, they contribute their funds into a pool, and this pool of fund is entered into a contract with some mudarib. So then here we have two types of agreements. Between these parties, the agreement is a partnership agreement or a Musharakah contract, and then collectively these people have a mudaraba contract between this capital provider and the manager. So in case of collective mudaraba, there are two types of partnership among the capital providers, and then the capital providers and the manager. Among the capital providers, it is the Musharakah contract, and from the capital providers to the entrepreneur, it is a mudaraba contract. And running mudaraba, it means a mudaraba is already in place. It is the business activities are already taken place, so the people, they can come into that business and they can take out their shares. So in this case, investors come in and go out at different dates. For example, if there is a funds management company and they they receive capital from the capital providers and they invest into a portfolio arrangement into the stock, into the shares of different companies. So then all the capital that is provided by different people into that running mudarba will be used to purchase or to invest into in the stock market. So in this situation, investors come in and go out at different dates, and the profits are calculated on daily basis. So in this case, profits are determined on running basis. At any time, if any client is leaving the partnership, then the share of his or her capital plus the profit or loss will be determined, and accordingly it will be paid to him or her. And redemption before maturity, it means at any time, if the assets of mudarba are in illiquid form, an investor may redeem his share by selling it to the pool. So in this case, if one of the partner wants to leave the partnership, the mudarba contract, in that case, the existing partners, they can take the share, they can purchase the share of the leaving partner, and if the assets are in liquid form, a provisional amount may be given to him subject to the final settlement. So in the case of liquid form, there will be no problem, and the cash can be given to the leaving partner as the capital that was contributed by him or her. So this was our today's lecture. Now let's summarize the different parts of this lecture. First of all, we discussed the features of mudarba, the definition of mudarba, and then nature of the contract, what was the capital, what was the nature of capital that should be invested into that particular contract, that is monetary assets or non-monetary assets, or the contribution in the case of debt claims like notes receivable or accounts receivable, and then management of the mudarba, and then profit and loss sharing mechanism. And also we discussed the termination of the mudarba, what will happen at the time of termination, and the collective mudarba, where the people, they join together, they create a pool of fund, and that pool of fund is used to engage into other business activities. And the running mudarba, in case of running mudarba, a funds management company or the mudarba is already in place. The people, they are taking care of a business, they are earning profits out of their business activities, and the people, they can come and go on the mudarba contract basis. They can invest their capital, they can take out their capital, and while taking out their capital, if the assets are in liquid form, they can be compensated accordingly. But if the assets are not in liquid form, their share can be purchased by the existing partners, or their share can be paid back when the assets are liquidated. So this was all about our today's lecture. Inshallah, see you in the next lecture. Till then, Assalamu alaikum.